Money, Power, and Monetary Regimes by Pavlina Tcherneva. Modern Monetary Regimes. One nation, one currency is the norm in modern economies. Goodhart, 1998, where nation-states assume full sovereign monopoly control over the currency issue. We nevertheless observe multiple cases of varying degrees of sovereignty where states voluntarily impose on themselves different monetary restrictions or abdicate their monetary sovereignty altogether. From here, we can classify monetary regimes according to the different degrees of monetary sovereignty. At one end of the spectrum are fully sovereign monetary regimes. These are cases where the state issues non-convertible free-floating national currency and the two agencies of government, the central bank and the Treasury or Ministry of Finance, coordinate to clear government payments and guarantee all state liabilities that are denominated in the domestic currency. In these cases, the ability to execute internal domestic policy does not depend on the shortage of government finance, but on political considerations and the availability of real domestic resources that can be transferred to the public sector for the purposes of achieving these objectives. Footnote 7. Note the emphasis on achieving domestic goals with domestic real resources. Countries like the U.S., which enjoy reserve currency status, have the ability to acquire many foreign-produced real resources that countries without such a status do not. But the foregoing analysis does not depend on the reserve currency status of a nation. Sovereignty here means that the issuer of the currency cannot be forced into an involuntary default in its own currency. It also means that the sovereign can, irrespective of the nation's external position, employ whatever domestic resources are available for domestic goals. Resource-poor countries may not have sufficient real domestic resources, which may necessitate the purchase of foreign exchange that will in turn have implications for the value of the domestic currency. But again, it will not necessitate an involuntary default in the domestic currency. It must be noted that even fully sovereign monetary regimes have institutional peculiarities, laws and practices that may constrain government spending according to some self-imposed or legacy rules. For example, debt ceiling requirements in the U.S., or the inability of the Treasury to run an overdraft on its account at the Fed. But even in these cases, the rules are regularly suspended or circumvented when the policy priorities dictate that the government must spend beyond these artificial constraints. Think of the Federal Reserve creating a Treasury supplement, essentially another account for the Treasury, at the stroke of a pen after the 2008 financial crisis, or of the routine practice of raising the debt limit in the U.S. on as-needed basis, political wrangling notwithstanding. Other countries, however, face hard financial constraints in executing domestic policy. At the other end of the spectrum are countries that have completely abdicated monetary sovereignty, thus giving up the right to issue and manage their own national currency. This is the case of dollarized nations, Ecuador and small Caribbean nations, for example, and member states in the European Monetary Union. In both cases, relinquishing monetary sovereignty has transformed those countries from currency issuers into currency users. To spend, the government of Ecuador must either earn or borrow dollars first. In this case, tax collections do raise revenue for the government. As an oil exporting nation, Ecuador has not yet faced a dollar shortage, even though it has pursued aggressive development and pro-growth policies, while simultaneously strengthening the welfare safety net. But with a gradual liberalization of financial markets and an increased standard of living in Ecuador, one can envision a future when the country becomes a net importer, losing foreign exchange dollars faster than it earns it, and thereby experiencing a monetary contraction and an overall deflationary environment. This, of course, is the case in the periphery countries of the Eurozone. They gave up their national currencies when they joined the monetary union. The situation is similar to that of Ecuador because, to conduct expansionary domestic policy, Eurozone governments must earn or borrow euros first. Net exports become the main channel for increasing a country's euro holdings, a strategy that describes the case of Germany, for example. But should a nation find itself in a net importing position, thereby losing euro reserves, as is the case in the periphery, the only way to fund government programs is by borrowing euros, by raising domestic taxes for revenue, or by cutting those programs. The latter, too, have contractionary effect, which undermines the government's ability to pursue its policy agenda further. The former, raising revenue through borrowing, puts the periphery nations at the mercy of the private market's willingness to finance these already heavily indebted nations. It also puts the periphery countries in a vicious Ponzi finance cycle, where more heavily indebted nations face rising costs of borrowing, thereby increasing their overall indebtedness, while further undermining their ability to repay their debt. The Eurozone has tried to solve its economic problems by becoming a net exporter vis-à-vis the rest of the world. It is well understood that net exports cannot be a global solution to economic problems, as for every net exporter there must be a net importer. But within the Eurozone itself, it is highly likely that there will always be some countries that are in a net importing position. Because the European Central Bank, ECB, is prohibited from financing Eurozone members by purchasing their government debt, the way the Bank of Japan or the Bank of England do, for example, the Eurozone lacks a fundamental mechanism for executing independent macroeconomic policy. Thus, member nations have given up unprecedented policy space to pursue domestic priorities, including the maintenance of some basic public sector functions or the implementation of pro-growth stimulus policies as needed. At the same time, the Eurozone as a whole lacks a central fiscal mechanism to conduct Euro-wide economic policy, as is normally the case in other monetary unions with a full monetary sovereignty, as in the US, Canada, or Australia. Countries that fall in between the two extremes, full monetary sovereignty and no monetary sovereignty, will have different degrees of policy space available to them. They can be ranked as follows, from the most to the least amount of policy space. 1. Non-convertible, freely floating sovereign currency regimes, as discussed above. US, Japan, UK, Canada, most countries in the world. In practice, these are often managed or dirty float systems as central banks intervene in currency markets. Number 2. Pegged floats, where the domestic currency is pegged to a foreign currency at a specific value or within a band. These are either fixed or periodically adjusted and vary from crawling bands to crawling pegs to pegged within a horizontal band. Number 3. Fixed exchange rate regimes, which promise direct convertibility into a foreign currency at a predetermined rate. Number 4. Currency boards, a much stricter form of a fixed exchange rate system, where the monetary authority operates on autopilot to fulfill absolute and unlimited convertibility between its notes and the foreign currency. And finally, dollarization, number 5, dollarization, and number 6, monetary unions. As long as a nation commits to convertibility, it will depend, to various degrees, on acquiring someone else's national currency, foreign reserves, for expanding the domestic issue. The goal of maintaining a stable exchange rate with a foreign currency will often conflict with other policy objectives, which will impede efforts to deal with recessions or bank crises. For this reason, fixed exchange rate regimes are often abandoned in the middle of severe economic and financial crises, freeing additional policy space to conduct independent macroeconomic stabilization, monetary, or fiscal policy. In fully sovereign monetary regimes, however, the economic possibilities before a nation with a freely floating, non-convertible national currency are constrained largely by political considerations and the availability of real resources to achieve those priorities, not by the availability of money. The final issue to address, then, is how can this policy space be used by a monetarily sovereign government for achieving various policy goals? The answer to that question will also help us debunk the final of the three myths from the start of this paper, namely that money is neutral and that in and of itself it does not affect employment and production decision. Figure 2. Modern monetary regimes and policy space. Greatest policy space, number 1, non-convertible, sovereign, free float, and dirty float. Number 2, pegged float, crawling band, crawling peg, horizontal band. Number 3, fixed exchange rates. Number 4, currency board. Number 5, dollarization. And the smallest policy space, number 6, monetary union.